With talk of a brewing China-US trade war, it may be useful to quickly recap the past 40 years of their economic relationship to help gauge the relative negotiating strengths of the two belligerents. Starting in the late 70s, the US began a rapprochement with China, which involved allowing them access to the American consumer market in exchange for denying the Soviets access to China's deepwater ports on the Pacific coast. This offer, essentially the same trade arrangement offered to America's post-World War II allies to facilitate their reconstruction, was basically a bribe to join the US-led anti-Soviet alliance. After the Cold War ended, the Americans sustained the relationship in an effort to cajole China into drifting towards market economics and democratic institutions. Another decade later, they offered larger carrots in the form of permanent normal trade relations starting in 1999 and helped to fast-track China's WTO ascension in 2001 despite the dominance of state-owned enterprises in many important sectors. While trade has been massive since that inflection point, it has been under deeply unbalanced conditions, with China blocking US firms from competing in a number of strategic industries, including banking, telecom, defense, food, logistics, education, healthcare, media, etc. The inequality of market access has driven the vast trade deficit between the two countries, which reached an accumulated sum since 1978 of over $4.5 trillion by the end of last year. Maintaining the status quo would see this sum double by 2030. Hence America's focus on opening Chinese markets as a way to rebalance their bilateral trade. For China, opening these domestic markets presents both economic and political challenges, and it will thus resist any kind of accommodation to the extent possible. Last year, China sent $462 billion worth of goods and services, and the US sent $115 billion, a net difference of roughly $350 billion. No country exports as much to another as China sends to the US, and unsurprisingly, a great number of Chinese jobs, roughly 11 million, are supported by access to America's $12 trillion consumer market. At the moment, approximately 1 in 150 American jobs are supported by exports to China, but that number is 1 in 70 on the other side of the ocean. In the unlikely event of a hard break in trade, there simply aren't any available replacement customers who could absorb China's excess production on the same scale that the US has for the past 4 decades. China's domestic consumer market is currently only 1/3 the size of the Americans. Big, but not dominant, and certainly not on a per capita basis, where the average American consumes $36,000 a year versus only $3,200 a year in China. The potential for large uptick in unemployment and corporate defaults that could ultimately require bank bailouts is real, and the Chinese government is alert to this vulnerability. Now conversely, the US has a lot of idle industrial capacity and workers that it could bring back online in sectors that are currently buying Chinese exports, to say nothing of China's numerous and eager rivals in low-skilled manufacturing. Perceived advantages in sectors like the mining of rare earths elements boil down to extraction costs, not geographic monopolies. Any mass divestment of treasuries would harm China, to say nothing of the US's ability to meet their obligations through the printing press. Put simply, the relationship between the two countries is broadly asymmetrical economically, with China's need for the status quo being far greater than that of the US. Much like our own trade relations with the US, they need America more than America needs them, at least for now. And that means that China's most likely going to blink first.